Now that Dawson Inc. has analyzed its variances for materials and labor during the period, they can book them, and they're going to book them using a standard, or sometimes referred to as normal, costing system. What does this mean? It means that when they record the entries that are necessary for the flow of costs through inventory, they're going to do so not at what they actually cost at the time, but what they should have cost according to their standards. Obviously, the actual costs that they're going to incur, the actual amount of funds they're going to have to pay to their vendors or to their employees, etc., are not going to line up with what they should have been according to their standards, which means we're going to need a little more going on in these journal entries. And that little more is accounting for the variances. So we're going to use just a ton of transitional variance accounts to make our journal entries have their debits equal their credits. Let's start with the direct material purchase entry, which I'm going to call entry A. If we're purchasing direct materials, we need to put them into inventory. We'll put it into direct material inventory, first step that we have. We're going to put them on the books at what they should have been. And if we paid the amount per square yard of wicker that we had anticipated, $550, to buy that 6,200 yards of wicker, we should have spent $34,100. That is what we would have paid had we hit our standards. And since we're using a standard costing system, that's what we're going to put it on the books for. But that obviously isn't what we actually paid. We had a variance in price. And since this is the purchases entry, we need to account for that price variance. And I'm going to debit direct materials price variance for the number that we calculated earlier, which was $1,240. But we're not paying the vendor that we purchased these goods from, this wicker from, what should have been. That's not going to work out if we call the vendor and be like, yeah, I know you're charging this much. We only budgeted for this much. Can we pay you that instead? It's not going to fly. We have to pay them what they're actually charging. So when we put the payable on the books for this wicker that we purchased, these direct materials, we need to put it on at what our actual cost incurred was. But our debits equal our credits. We got $35,340 on each side in the entry to record direct material purchases for the period. What about the usage of direct materials? Taking them out of storage and putting them into production, which we're going to do in journal entry B. Well, we're using materials which are an inventoriable cost in production, which means it needs to go into our work in process inventory. And one more time, we're going to put this amount in at what it should have been had we hit our standards. If we used 3 square yards of wicker for each chair, and each one cost us $550, each yard cost us $550, then making 2,200 chairs should have cost us $36,300. It obviously did not, because we had an efficiency variance for direct materials of $2,200 according to our calculations. Well, where would these materials have come from? They would have came out of our storage, which we were containing in our direct materials inventory. And we put $34,100 on the books in our first entry when we recorded the purchase of those direct materials, which thankfully, now that we're taking out and using in production, is the same amount that we need to credit here to make our debits equal our credits in the journal entry to record direct material usage for the period. So we're moving the costs through our inventory accounts from direct materials, well, into direct materials inventory and then into WIP at what it should have been. And if we're off from our prediction to what actually happened, we're recording the variance. I debited direct materials price variance in the direct material purchases entry. I credited direct materials efficiency variance in the direct material usage entry. How did I know how to do that? Because the rule of thumb is as such. If you have an unfavorable variance, like we did over here for direct materials price, pardon my arrow, you know it has to be a debit in your journal entry. If you have a favorable variance, like we did over here for our efficiency variance, it has to be a credit in your entry. And the reason being right here is because our numbers at our standards are not going to line up with what we actually had. Let's move on and do the same process for labor. And because all of these costs are going to go into our WIP, we don't need to have separate entries for purchases or usage. Like in direct materials, the purchases go into direct materials inventory while usage goes into WIP. And this, all of it's going to go into WIP. So we only need one entry for labor. And in journal entry C, that's exactly where we're going to start. We're going to debit WIP to start this entry out. What are we going to debit WIP for? We're using a standard costing system, which means we put costs for labor into our WIP account at what it should have been had we hit our standards, which is $11,550. If each chair took a half an hour to produce and each labor hour costs us $10.50 on average, well then we should have paid $11,550 to produce the 2,200 chairs that we actually made. Of course, that's not what ended up actually happening, because we had a price variance for direct labor of 184, which I know to debit because it's an unfavorable variance, and unfavorable variances get debited. We had an efficiency variance of 1,890, which I know to credit because favorable variances get credited. And then we have to account for what we actually paid in costs. Well, we actually paid $9,844. So again, we're not going to give our employees $11,550 because we thought it was going to take them longer to make goods than it actually took them. No, we're going to pay them for the actual amount of time that they worked. So wages payable, in this case, is what I use. It could be cash if you're actually physically paying your salaries. That's going to go on at the actual amount in the journal entry to record your direct labor costs for the period. So it's an unusual system. I will definitely agree to that. But it does one grand thing for cost accountants. It allows you to easily produce a standard cost income statement. And a standard cost income statement is a variation of the income statement that helps management, when they're making a decision, know what all those variances were in one convenient place for reference. And essentially, we are making this document for internal purposes so we can hand it to production supervisors, to purchasing managers, to people running the company. And they don't have to go through and do all of the calculations from these numbers. We gave them the variances in one place. We're going to start with our sales revenue, which we'll assume for Dawson was $80,000. Then we're going to list our cost of goods sold at what it should have been had we hit all our standards. Well, we determined that had we used the amount of wicker per chair and paid the amount per square yard of wicker that we thought we were going to, we should have spent $36,300 in materials. We also determined that had each chair taken a half an hour and each labor hour cost us $10.50 on average, we should have spent $11,550 in labor costs. Assuming there's no overhead, we'll get to that at some other point in this chapter. That means that in total, if we hit our standards just for materials and labor, we should have had cost of goods sold of $47,850. Those two numbers add together. But that's not what happened, because we had a direct material price variance of $1,240. We had a direct material efficiency variance of $2,200. We had a direct labor price variance of $184. We had a direct labor efficiency variance of $1,890. I put some of those numbers on there as negatives and some as positives. Why would I do that? Well, these are costs. If something is unfavorable, it's increasing your cost, and therefore when you ultimately sell stuff, it's going to increase the amount of cost of goods sold that you report. So unfavorable variances, like we had for both of our price variances, should be increasing your cost of goods sold from what it would have been at standard. Favorable variances, they mean we used less of something that caused us to incur less costs. And since we incurred less costs because of that efficiency variance being favorable, it should be lowering our cost of goods sold from what it should have been a standard. So on your standard cost income statement, favorable variances get subtracted. And then we can sum up in this case that we have 4 different variances, and we come up with a total of $2,666 favorable. We spent $2,666 less producing goods, which we eventually sold, than we should have had we hit all the standards that we budgeted for in the first place. So our actual cost of goods sold was not the $47,850 that we had planned on. It was $2,666 lower than that. It was $45,184. And you can make sure that number jibes because it should be equal to the sum of your actuals, and it is here. $35,340 plus $9,844 is indeed $45,184. And now, since we have sales revenue of $80,000 and actual cost of goods sold of $45,184, we know that our gross profit was actually $34,816. And if we're assuming we had $14,816 of non-manufacturing costs, all of our period costs, our SG&A expenses, etc., we'd end up with operating income of $20,000. So this document is a great thing to have for the sake of easy reference for that management by exception we were talking about. We know where our biggest variances are now, and both of our biggest variances are efficiency variances. We used way less materials than were budgeted for originally. It took our workers way less hours than things were budgeted for originally. Typically, in standard practice, both of those standards are going to be set by your production supervisor. So if I am managing Dawson Incorporated, my first step to figure out where things went awry from our budget is to talk to that production supervisor and be like, where were you getting these numbers for wicker and for labor? Because we didn't even come close to that much. I know they're favorable, so you would think that, it's cheaper, it's got to be good. But that's money that we set aside for the purpose of production that we could have used elsewhere. We could have increased production of another product if we have one. Or we could have at least spent it on further research and development or more advertising or something. We tied up money in here. And I have a feeling that that was a bad estimate by this production supervisor for the actual time and quantity of goods that had to go into production of these wicker chairs.